The U.S. economy has slowed significantly from last year's rapid pace.
The level of economic activity is likely to be flat and even fall for some time.
Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions.
People at the lower end of the income spectrum are reporting that they are really having difficulty making ends meet.
For a long time, inflation had been low and stable. Most people did not have to worry about inflation, but that has changed.
The recent inflation data, again, have come in higher than expected.
Consumer price inflation now stands at over 10%. But I know for many people it will feel worse because the prices of essentials like energy and groceries have risen by much more.
Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate.
We have one of the largest upside risks to inflation in our forecast that we've had in the 25-year history of the MPC.
The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. It will take time, however, for the full effects of monetary restraint to be realized.
If we do not act forcefully now, it will be worse later on.
In the last 2 days, the US Federal Reserve increased rates by 75 basis points to a rate of 4%, the highest rate since January 2008. Bank of England in the UK has also increased rates by 75 basis points, something they have not done for over 30 years. Andrew Bailey, the governor of the Bank of England, has just declared that the UK economy is probably already in a recession, and the official Bank of England projection is that this recession will last until mid-2024, which would make it the longest recession in history. The stock market is an absolute freefall, falling 5% in the last week, going up and down every day for no particular reason, down over 22% so far this year. And the world is in full-on panic mode. Bad news is good news for the media, who are publishing non-stop doomsday scenario predictions, and exactly 1 year ago, every financial commentator would tell you that the stock market is about to explode. You have to go and buy in because the stock market had one of the biggest bull runs in history, raking in huge gains for 3 years in a row. And now, after the stock market has fallen, those same tea leaf fortune tellers are there telling you that everything is of course about to collapse another 50% from here. Michael Berry and Jeremy Grantham, who have perfectly predicted all 69 of the last 3 financial crashes, have once again proven that if you shout wolf long enough, eventually after a few years, one is going to turn up, and a growing number of voices are getting swallowed by the panic. You've probably noticed the anchors on CNBC or your favorite finance YouTuber changing their tune 180 degrees. Long-term projections, of course, do not matter at all anymore because the world is now burning, and every long-term investor with a 20-year horizon on their investments has suddenly mastered the art of candlestick wizardry, a mysterious craft that shows financial charts to a black cat at exactly midnight on a full moon and listens to the pitch of the meow that the cat makes to predict exactly which way the stock market is going to go tomorrow. The noise can be deafening, and it can be very easy to start questioning whether you are blind to the obvious impending doom. I mean, how much clearer can it possibly be? The biggest companies in the world are missing on their earnings. In the last week, Google missed and fell 10%, Amazon missed and fell 10%, Facebook has spent $40 billion on making avatars without legs when they could have bought a Nintendo Wii with superior graphics and avatars that do have legs for $40 on eBay. Stock prices are falling so low you might soon get paid to own stocks. But just before you go and sell out of all of your stocks because a financial expert on YouTube who happens to have no financial background whatsoever told you to sell, take a moment to step out of the never-ending hum of the doom and gloom and take a look at what's actually going on. The US Federal Reserve, Bank of England, and most central banks around the world are all telling you in unison that they absolutely exactly know how far the economy is going to collapse in the next 2 years. They have these armies of analysts, they're producing these reports with charts and numbers and data and stuff. The worst recession since the 1930s is on the way. The stock market will have the biggest fall in recorded history. You better believe it. But then consider that these same people just 1 year ago were telling you something very different. Just 12 months ago, Jerome Powell told the US Congress that inflation was transitory and was going to disappear all by itself. In December 2021, the Fed projected that the GDP would grow by 4% in 2022. This forecast increased from the 3.8% that the Fed was projecting in September 2021. In that same December 2021 meeting, 16 out of the 18 members of the FOMC agreed that interest rates this year in 2022 would stay under 1%, with the other two thinking maybe they'll just go just above the 1% mark. At the same time, interest rates were at a historically low rate of just above 0% just a few months ago, while inflation in December hit 7%. The gap between the 7% level of inflation and the 0% interest rates was by far the biggest in recorded history. And yet today, this Muppet show that couldn't tell their ass from their elbow yesterday are suddenly being put up on a forecasting pedestal. It's a bit like walking up to a roulette table, watching an idiot place his life savings onto the table and lose it all, and then asking that idiot for advice on where you should place all of your money on the very next spin. It sounds ludicrous, but that is exactly what's happening right now, because hysteria has a funny way of absolutely weirdly changing people's perspectives. Here are some basic facts about the state of the economy today. Natural gas prices have fallen by over a third since their peak during the summer, as the world and Europe in particular were panicking about Russia cutting off supplies. Increases in production in Norway and Netherlands, record-breaking supplies of liquefied natural gas from the United States, a new deal with Azerbaijan, and a mild October have all calmed the markets. Oil price remains relatively high at around $90, but is also substantially lower than the peak back in June. Inflation in the US is at 8.2%, and lower energy prices are masking the fact that overall inflation is still running very hot. Food prices are going up 1% a month, shelter and the CPI index is increasing at 0.7% a month, and probably going to increase further than that. But after the most recent increase, interest rates are now at 4%. The gap between inflation and interest rates is now down to 4.2%, a very substantial decline from a gap of almost 8% in February this year. And in addition to rates going up faster than inflation after 3 consecutive 75 basis point hikes, the Fed is also implementing a quantitative tightening program which has never been done before. And this program should enhance the effect of increasing rates. Multiply the effect. US employment remains very strong, which is surprising, but a very good sign despite the situation in the economy and the actions of the Fed. And at the same time, consumer demand in the US is falling sharply, a very unique set of circumstances. We saw AMD post results in the last few days, where demand for their expensive computer processors from retail clients specifically fell by over 50% in just 2 months. And this fall in demand means that heat is already being taken out of the economy, as people cannot afford to spend money because inflation is putting a lot of pressure on their ability to spend their wages. The Zumper report showed that inflation in rent prices has started falling back in June and dropped a lot more sharply in October, the first such decline in 2 years. The upward pressure on inflation has started to reduce, even as CPI is catching up because of the lag effects. At the same time, we're seeing a very interesting effect in the post-COVID stock market performance. During COVID, many companies absolutely blew up, some out of nowhere. People were sat at home, stimmy checks and financial support was being thrown at these people at the same time as they were sat at home not spending any money on going out. And many companies from Zoom to Facebook to Peloton saw absolutely ridiculous growth that was not in any way sustainable. Many of these companies saw their share price boom as well and go absolutely bonkers as a result. And now, most of those bubbles have burst. Zoom is trading at below the price that it was at before COVID. Amazon is trading at below the price that it was before COVID. Growth stocks like Fiverr are trading at below the price that they were before COVID. And we are seeing earnings scores happening right now, every day, where performance today is being compared to the ridiculous performance a year ago during COVID. So growth of every company has fallen in recent quarters, but many of these companies have seen their revenues grow in the last 3 years. And while the rate of growth now is a bit slower because it is being compared to some bonkers growth before, the P&Ls and balance sheets of many of these companies are in a much better place than they were 3 years ago before COVID arrived. And after the inevitable unwind in the year after COVID that we are witnessing right now, you have to ask yourself the question: The Fed is more than halfway on the way to matching interest rates with inflation. With QT, they might be a lot further along, maybe 70 or 80% of the way there. Corporate profits are about to come out of the COVID lapping effect, and next year's performance will then begin being compared to this year's performance. And numbers suddenly might begin looking a bit different. Despite a squeeze on people's budgets, we have a relatively unusual financial crash during which employment has remained stubbornly resilient. Just this morning, non-farm payroll numbers came in way better than expected at plus 260,000. And this means that if employment remains resilient as a recovery starts, the economy will be in a far better shape to accelerate out of the turn than in any of the recent previous recessions when unemployment rates skyrocketed. Back in February, after Russia invaded Ukraine, Eastern Europe was concerned that Putin would roll his tanks west, taking one country after another. Today, Russia is retreating in Ukraine as the fearsome Russian army appears to be made up of mobilized civilians with zero training and a rusty AK-47. Just as we didn't know about the war in Ukraine a year ago, we do not know what will happen next year. Absolutely no idea what the next year is going to bring. I don't know, you don't know, the Nostradamus financial experts telling you they do know have absolutely no fucking idea. So before you stop being a long-term investor and join the dark side of the gambling degenerates trading candlestick patterns, remember that technical analysis never lies. And technical analysis conclusively proves that the S&P 500 is about to boom 100%, definitely for sure, because look, it says so on the chart. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching, I really appreciate it, and as always, I'll see you guys later.